We're looking at 5 accounts that every person must have, but specifically this video is for retirees. 5 accounts that every retiree must have in Kenya, and we shall also go down and look at their function. Now, most people only know of one account, a savings account, but I've come to inform you that there are so many accounts, but particularly for retirees and for reasons that we shall discuss, you need 5 accounts that will be able to sustain you. And most retirees retire with a lump sum, but after 2 or 3 years, that amount of money is gone. Where does it go? It covers medical expenses, covers family pressure, covers businesses that fail at some point, and inflation that is silently eating away the cash. And suddenly, the money that was supposed to serve you for 10 years, for 15 years, it's gone. It's finished. And the uncomfortable truth is that retirement doesn't always fail because of low money. It fails because of poor structure. You don't have systems in place that will be able to keep that money for you for a long period of time. And that's why today I'm going to take you through these 5 important accounts that every retiree must have beyond the savings account. So each account that we shall look at has got a specific job that we shall be exploring. Because if you don't have a structure for your money, even if you're given 100 million, but you don't have a structure for your money, and because when you talk about structure in this video, I'm talking now about those accounts, because those accounts will give you a structure. Now, before we will reveal the 5 accounts, let's look at the retirement trap that most people always find themselves in. Now, when you retire, something happens. Your salary will stop. Of course, you'll continue to be paid, but it will not be the amount that you have been paid. So your salary will stop, or others it reduces, others it stops. Your expenses will not stop. Your medical costs will certainly increase because of your age, and inflation will always be knocking on your door. But now, this is the math problem, that most Kenyan savings account, the one that you only have, gives you interest between 3 and 5%. But inflation is 6 to 8%. What does this imply? It means that you are losing the purchasing power of your money every single day, quietly, silently, and predictably. And the most mistake that most people make is they keep all their money in one place, in a bank account, in a fixed deposit account, or in one circle, or in one business. But that is not strategy, that is exposure. You are exposing your money to elements of inflation, to elements of easy access. And that exposure doesn't sit well, because retirement needs a system, it needs a structure and a network. So the 5 accounts with 5 different functions, let's look at account number 1. So the very first account that you need, we've talked about this account on so many times on this channel. It's a money market fund account, MMF. And when we talk about money market fund, I want you to think about an emergency engine. Your emergency engine. Money market funds invest in treasury bills, which mature early. They invest in bank deposit. They also invest in commercial paper. They can be, money market funds can be accessed through platforms like CIC. They have got a platform, Sanlam, NCBA. Essentially, all the money market funds have got a platform where you can access them through your phone via an app. Now, why do retirees need money market fund? Because number 1, the interest currently is it varies. There are those that are paying 10%, 11%, 12%. So the earning is between 10% to something like around 13%, 15% annually. Understand that this figure is much higher than what we get from a savings account. Reason number 2, the interest is calculated daily, and of course the returns deposited in your account. Then number 3, withdrawal is between 1 day and 3 business days. It beats inflation because the rate is higher than inflation, then the money is not locked in. This is why you keep like 3 to 6 months of your expenses, so that if you spend 50,000 monthly and you've got a large amount of money, this is why you keep 200, 300, 400,000 in a money market fund. It's important for you to note the following, that your emergency money should not sit idle. It should earn interest but remain liquid at all times. That's why we advocate for money market fund. And this is only the beginning, because now we move from liquidity, our account number 1, to ownership. So account number 2, we call it Bosa account. And this one is an account, Bosa, BOSA. This is an account of a SACCO. There are two kinds of account that you get in a SACCO: the FOSA account and the Bosa account. FOSA stands for front office service activity, and Bosa stands for back office service activity. Now, the front office is one that enables you to withdraw money, ATM, but Bosa one is the one for investment. Why does this account matter, Bosa account? Because the yields or the returns for SACCOs are between 8% to 15% annually. It is higher than most banks. And the difference is that while banks pay you interest, SACCOs will share profit with you. You are a co-owner, you are a member, you are an investor in that particular SACCO. But the hidden advantage that most people ignore is this, that number 1, access to credit facility. If you need a medical loan, a repair loan, an emergency loan, a SACCO gives you access to easier credit facility without collateral drama, but very important that you can access that money very easily. Now, most SACCOs will require contribution history before they give you full benefits. And ensure, when choosing a SACCO, I've always said that ensure is regulated by SASRA to avoid, just to take care of the risk of losing your money and make sure that your money is safe. Now that you have covered liquidity under money market funds, and we have covered SACCOs for high yield savings, now let's talk about something that gives us predictable income. And this next account is very powerful. So account number 3 is DAO CSD. DAO CSD account. This is the account for government bonds and treasury bills. Now, I like calling this your income machine. Why? Because it gives you higher interest, higher returns as compared to any other vehicle, as compared to any other account. And number 2, it's backed by Central Bank of Kenya. So you are assured that the returns are minimal, if not none, because the government has never defaulted. The government rarely defaults. So what this account does, that it allows Kenyans to buy treasury bills and treasury bonds directly online without middlemen. Why do retirees love this account? Because of, number 1, very high or competitive rates. The treasury bonds currently offer between 14% and 18%, depending on the issue. These rates might be higher or might be lower at the time that you are watching this, but that is always the range. They are backed by the government of Kenya, and here is how it works. For example, if you invest $500,000 in a 15% bond, it means that at the end of the year, if we take 15% of $500,000, that is 75,000 per year, but they'll pay you biannual, which means they'll pay you after 6 months. So after every 6 months, you'll get 37,500. Just like a clockwork, it's guaranteed. So this is how retirees can cover something like food, utilities, school fees, or medical insurance, or any other emergency that comes up without touching your principal, because your principal is still safe. We have got treasury bills and bonds. Just a quick reminder, because we've talked about this, that bills are short term. We have 91 days, we have 182 days, then you have got 364 days. But now treasury bonds are long term, between 2 to 30 years. If retirement needs predictability, this is your foundation. But income alone is not enough. I always say that you also need a structure. So let's move to account number 4. Then we shall be having one more remaining. So this one is a pension account. Pension account. We can also call it income drawdown, like you get income from that particular account. Now, this account, this is pension. Pension account is regulated by Retirement Benefits Authority, RBA, and this is your salary replacement system. It's not money that will give you luxury, because if it pays you 20,000 or 30,000 per month, this is not money for luxury, or it's not money for development. It's just supposed to take care of your basic essentials, necessities, and make sure that you are well kept. You might not live luxury, but you are well kept. So that instead of withdrawing everything at once, lump sum, you keep the balance invested and draw on a monthly basis. Why does this account matter? Because it gives you tax advantages, it gives you control withdrawals over time, and it gives you continued growth, because because the money is invested, so it gives you some percentage between 8% to 12%, depending with where the money is invested. A drawdown account, like where you're drawing money on a regular basis, it's important because number one, it prevents overspending. Number two, it helps you avoid emotional lump sum decisions. Just thinking that I've got 5 million in my account, tomorrow I can go to I can take a flight to Malaysia. Tomorrow I can take a flight to Malawi. Think of any country. So it removes the emotional lump sum decisions. Then number three, running out of money too early. You won't run out of money too early because you don't have access to the lump sum in the first place. You are given that money in on a monthly basis. So if you are still working, listen to me, or if retired, maximize pension now. Ask about income drawdown account now, so that you're able to start putting structures in place. Now that we've covered safety, we've covered structure, the final account will fight something very dangerous. It fights inflation. That is why account number 5 is what we call a CDS account, or also can also be called a brokerage account. Brokerage account. And you've heard about NSE, Nairobi Securities Exchange. You've heard about stocks and shares. I've talked about them on this channel. So a CDS account is your growth engine. You open a CDS account via licensed brokers. There are so many, we've talked about them. And this account will allow you to buy shares on the Nairobi Securities Exchange. Examples of dividend-paying companies, companies like blue chip companies like Safaricom, Equity Bank, KCB Bank, they have been paying consistently for a very long period of time. They pay dividends, they grow your earnings, and then they increase the share value over a long period of time. Now, the returns might be lower, between 5 to 8%, which varies on an annual basis and also varies depending with what company that you're investing in and which industry is that company found. Now, this account will protect against inflation, will provide capital appreciation and sometimes preservation, and it adds dividend income. But caution, do not put more than 10 to 15% of your retirement savings in an individual stocks. Always do what? Diversify in different, but in different, I'm looking for a term, in different stocks, in different industry at the same time. Those marks the end of the 5 accounts. But just before we end, our accounts alone are not enough. It's important that you have principles that will enable you to execute better. And so we are going to look at 5 principles that will make all those work, because accounts alone will not work. So principle number 1 is diversification. You've realized that each account that you have talked about has got a role, it has got a function. Money market funds, emergency. SACCOs, high yield saving. Bonds, predictable income. Pension, salary replacement. Stocks, they are there for growth. So one account failing should not destroy you. Principle number 2, inflation protection. Any account earning below inflation is shrinking. Why? Because your money is losing value. If money is earning an interest of 3% or 4% and inflation is 6%, it means that your money is slowly losing its value. But when you have a combination, you combine your system the way we are looking at them, then you beat inflation. Principle number 3, tax efficiency. Use pension tax benefits. Don't donate money unnecessarily to Kenya Revenue Authority. Principle number 4, liquidity planning. Have in mind, Know what you can access quickly. Never sell bonds or stocks in panic. And always maintain 3 to 6 month liquid money. That is the money that is in money market fund for emergency purposes. Then principle number five, sorry, estate planning. Update beneficiaries, write a will. Money without clarity creates family conflict. So retirement is not just about survival, it's about a legacy. So just to recap what we have talked about, we've talked about 5 important accounts that anyone must have, especially when you are retiring. The first account is money market fund, and it acts as an emergency buffer. It gives you liquidity. Account number 2, we've talked about Bosa account. It gives you high dividend savings, enables you to save and access credit facility because it's an account for circles. Account number 3 is DAO CSD for bonds. It gives you predictable income. Account number 4 is pension drawdown account, and it gives you salary replacement. Account number 5 is the brokerage account, or also known as the CDS account. It's an inflation fighter. So you don't need all 5 today at once, but start with one. And one or two, I recommend the following. Open a money market fund account. I'll leave a link for you here to sign up with the ticker. I use the ticker money market fund. It's easy, it's convenient, your funds are accessible anytime you want them. So I leave the link for you to have a look at it. I'll also leave a video on how you can start investing in government bills and bonds. We've done that video before, so I'll leave it in the description, but I'll also have it attached up here. So start with those two, then build the rest slowly. So retirement in Kenya does not have to mean stress. And why do I say so? Because people wait until it's too long for them to start planning. Retirement means freedom. It means control. It means dignity. It means legacy. And if this video helped you and helped you have a different perspective or understanding, please give it a like and subscribe. A good number of viewers haven't subscribed. And one single way to support the work that we do here is if you just subscribe it to the channel. Share with someone who is retiring soon, and comment below which of these 5 retirement accounts do you already have, or which one do you plan to open soon. And I read every comment, so if you leave comments, if you have questions, leave the comments and I will reply to all of them. Until next time, plan wisely, invest wisely, and grow intentionally. I'll see you in the next video. Bye bye for now.